I've been buying the dip for most of my investment career. I only buy when the market's on sale. Here's how I do it. Okay, first of all, this is not financial advice. I don't know your situation. If you are a business owner or have lumpy income in the sense of you get paid out in bonuses and you don't quite know how much you're going to make month to month, quarter to quarter, or year to year, I think it's probably more fitting for that type of person. In my career, I didn't know quite how much I was going to make. And I hated just getting a check and going right into the market blindly, sometimes at all-time highs. So I created a system where, okay, let me sit on the cash for a little bit and wait for the right opportunity to get in. A few things to think through is I was a medium to very long-term investor, and I wanted to remove as much emotion from the decision making when it was time to buy. Because as you know, when the market is on sale, there's a lot of volatility and it feels crazy, and I just needed it to be black and white. It's time to go in. Here's how I do it. Okay, so my system is tied to something called the VVIX. Okay, there's the VIX, which if you don't know what that is, it's the implied volatility of the S&P 500. In layman's terms, that basically means how much investors are willing to pay for insurance for the stock market. The old adage is, if the VIX is low, it's time to go. The VIX is high, it's time to buy. I focus on the second part. When the VIX is high, it's time to buy. Okay. The VVIX is a same methodology, but against the VIX. So derivative of a derivative. And that signal is what determines when I'm buying. Okay. I know it's confusing. Let's look at a chart. All right. So this is a chart of VVIX, not to be mistaken with VIX. Okay. This is the volatility of VIX. Okay. And it's a weekly chart. And as you can tell, it oscillates. I mean, this thing looks like a Richter scale, right? Clear floor. This is back in 2014. 60 hasn't ever really gone lower than 60. 70 is kind of a floor, and maybe even 80 at various times. On the flip side, you can see the ceiling, the spikes here. 125, 120. There's a little bit more volatile spikes post-COVID. But in general, it tends to fluctuate between this 80 to, let's call it 130, okay, with the exception of a few outlier major spikes. So like I mentioned, the signal that I wanted to create was based on this, and the theory is, when does volatility pop, prices retract, okay, and obviously they go hand in hand. And is there a sweet spot period of time where prices are still retracted, but volatility is starting to come back down? Okay. When the VVIX closes on a Friday over 110, okay, and you could play around with that number. It could be 100, you'll get more signals. You can go 120, you go to 140, you'll get less signals, probably a little bit juicier ones. But for me, I found the sweet spot of the amount of signals and the efficiency of the signals to be better. 110, I'm not doing anything. I wait another week. And if we're lower than the previous week, it's time to go in. Okay. And a lot of times the prices are still contracted, but things are calming down, if you will. Now, if it's, let's just say we close at 114 and the next week we're even higher at 124, I'm still waiting another week. I want to see it kind of come off. All right. That's the signal. And when I say buying, by the way, I'm not buying VVIX. I'm buying VTI, SPY, just broad market indexes. You can choose sort of what instrument you want to trade on actually or invest in, but use this as a signal, if you will. Okay, so pretty simple, right? And that's the idea. Keep it simple, keep it black and white, remove the emotion, just go in. And again, if you're like me, I hate buying all-time highs. I don't feel comfortable doing that. I like buying dips. I have found this system to work pretty well. It keeps me focused. I ignore the news. I just look at the signal and I go in. The question, though, you need to ask yourself is, well, how well does it really do, right? How does the portfolio of this strategy compare to the other two alternatives, which is dollar cost averaging and lump sum investing? Well, let's take a look. In my next video, I'm going to show a walkthrough of the methodology with a fictitious salary and bonus structure of an employee or an entrepreneur who just goes in the market using this strategy versus the other two. All right, so let's take a look. I look forward to seeing you in the next video. Thanks.